you earn $200,000 in Ontario, it can feel like you should be keeping most of it. But once the federal tax, provincial tax, CPP, EI, and the Ontario health premium are factored in, the take-home number can look very different. And for planning purposes, the most important number may not be your salary. It may be the tax rate on your next dollar of income. So today, we're going to walk through what a $200,000 earner in Ontario may actually take home in 2026, where the money goes, and the planning decisions that can help you keep more of what you earn. I'm Kris Dureau from Green Private Wealth. Our mission is to help Canadian families turn financial complexity into a clear, actionable plan so you know where you stand and how your future is protected. So let's get into it. Okay, so let's start with the numbers. These are estimates based on a $200,000 of employment income in Ontario, with standard credits applied. Your actual result will depend on deductions, credits, benefits, pension contributions, charitable giving, and of course, personal circumstances. But this gives us a realistic ballpark. First, there is a federal income tax. Canada uses a progressive tax system, which means different portions of your income are taxed at different rates. For 2026, $200,000 part of your income falls into the 29% federal tax bracket. Your estimated federal tax before credits is roughly $42,000. After standard credits, you are looking at approximately $39,000 to $40,000 in federal tax. Then there's the Ontario provincial tax. Ontario also uses progressive brackets, starting at 5.05% and rising as income increases. At $200,000 of income, the base Ontario tax is approximately at $18,000 before surtax. Ontario also applies a surtax once provincial tax crosses certain thresholds. After factoring in the surtax and basic credits, total Ontario tax is roughly $23,000 to $24,000 before the Ontario health premium. Then there are the payroll deductions. For 2026, maximum employee CPP contributions are about $4,230 plus up to $416 for CPP2. EI premiums are capped at about $1,123, and at $200,000 of income, the Ontario health premium is $750. So when we add that up, federal tax is roughly $39,000 to $40,000. Ontario tax, including that surtax, is roughly $22,000 to $23,000.
Payroll deductions, approximately $6,519.
That brings the total deductions to roughly $68,000 to $70,000, somewhere in between that. So on a $200,000 salary, estimated take-home pay is roughly $130,000 to $132,000. That means your average effective tax and deduction rate is around 34%. So you're not losing half of every dollar you earn, but that's only part of the story. The next number is the one that drives most planning decisions. Your average tax rate tells you what you paid across your full income. Your marginal tax rate tells you what happens to the next dollar you earn. And $200,000 of taxable income in Ontario, your combined federal and provincial marginal tax rate on ordinary income is roughly 48%, getting close to half. That means if you earn an extra dollar through a bonus, additional employment income, interest income, or other fully taxable income, you may keep a little over half of it. That marginal rate now is not applied to everything you earn. It only applies to the income within that bracket. But it matters because it affects the value of the planning decisions. If you make an RRSP contribution, you earn a bonus, or generate interest income in a non-registered tax account, all of that is tied to your marginal tax rate. And if your taxable income rises above $258,482, the top combined marginal rate in Ontario reaches about 53.53%. So at this income level, tax planning starts to matter a lot more. Okay, so what can actually be done about this? The goal is not to avoid tax altogether. The goal is to use the planning tools available to you properly. The first area is RRSP contributions. Every dollar you contribute to an RRSP generally reduces your taxable income dollar for dollar within your available contribution room, of course. And at a marginal tax rate around 48%, a $20,000 RRSP contribution could save you roughly $9,500 to $10,000 in tax today, depending on your exact income, credits, and deductions. That money also goes into a tax shelter account where it can grow until you draw it out later, ideally in retirement when your income and tax hopefully is lower. The 2026 RRSP dollar limit this year is $33,810. Your personal room is based on 18% of your prior year earned income minus pension adjustments plus any unused room carried forward. So if you've not been maximizing your RRSP contributions and you're in a higher tax bracket now and potentially lower in retirement, it may be useful to use up some of this meaningful room that's available for you. Second area is investment income structuring. At $200,000 of employment income, additional investment income in a non-registered account is stacked up on top of your existing income. Interest income is usually the least tax efficient because it's fully taxable at your marginal rate. Capital gains and eligible Canadian dividends are taxed differently, but they still need to be managed carefully. This is why asset location matters. Simple terms, it means asking whether the right investments are just simply sitting in the right accounts. The third area is compensation planning, especially for incorporated business owners or professionals. If you are incorporated, there may be a planning opportunity around salary, dividends, retained corporate earnings, and corporate investment accounts. But this needs careful coordination with a tax professional. The right answer depends on cash flow needs, corporate income, personal income, retirement goals, family situation, and how the corporation fits into the broader plan. Now, the bigger point is this: tax planning is not only about one deduction or one account. It's about how all the pieces work together. At this income level, small planning decisions can make a real difference to what you keep after tax. And over a career, those differences can add up in a meaningful way. But the goal isn't to chase every tax strategy. The goal is to build a financial plan where tax efficiency supports the larger objective. That could mean saving more for retirement, building wealth more efficiently, managing future taxable income, reducing tax drag on investment returns, or creating more flexibility for your family. The tax conversation should not only happen once a year at filing time. By then, many planning windows have already closed. The more useful conversation happens throughout the year, while there's still time to make decisions. On a $200,000 salary in Ontario in 2026, you may take home roughly $130,000 to $132,000 after federal tax, Ontario tax, CPP, EI, and the Ontario Health Premium. Your average effective tax and deduction rate's around 34%. But your marginal tax rate on the next dollar of ordinary income is closer to half, 48%, and can rise further at higher incomes. Those numbers are not always comfortable. Look, we're almost getting close to half, but they are useful because once you understand where the money is going, you can make better planning decisions around this. RRSP contributions, investment structure, compensation, and long-term tax efficiency. Look, the goal here is not to avoid paying tax. The goal is to avoid paying more than necessary tax. If you want to go deeper on tax-efficient investing in Canada, please download our free guide. It covers practical strategies for reducing tax drag, structuring your investments more efficiently, and keeping more of what you earn. You can find the link in the description below. And if this video was useful, please give it a like, share it with someone earning at a similar level who's never seen the full tax breakdown, and subscribe for more financial content for Canadians. I'm Kris Dureau with Green Private Wealth. Thank you for watching, and we'll see you in the next one.